Three completely different asset classes are selling off at exactly the same moment: crypto, Korean chipmakers, and US semiconductor stocks. That kind of synchronized move doesn't happen by accident. When Ether, XRP, and Dogecoin are dropping in lockstep, with Micron falling 6% in pre-market and Korean stocks slumping by the same margin, you're not watching individual stories. You're watching a single story told across multiple markets simultaneously. The real question is, what is that story and are you reading it correctly? Let's establish what we actually know before we start building narratives around it. As of today, June 26, 2026, Ether, XRP, and Dogecoin are leading a broad crypto sell-off. Korean stocks have slumped approximately 6%, with chipmakers taking the heaviest damage. Micron is down around 6% in pre-market, pairing what had been earlier gains. Tech stocks more broadly are tumbling. Those are the confirmed data points from this morning's headlines. Here is what that pattern tells a sophisticated market observer. When crypto sells off alongside semiconductors, it is almost never about crypto-specific news. Crypto, despite its reputation for idiosyncratic volatility, has become increasingly tethered to risk sentiment. When institutional capital gets nervous, it does not carefully sort its portfolio into crypto bad and tech good buckets. It pulls back from the entire risk spectrum simultaneously. The phrase broad sell-off in the CoinDesk headline is doing a lot of work. Broad means this is not a single coin event. It's not a hack, a regulatory action against one protocol, or a whale liquidation. It is indiscriminate selling. Indiscriminate selling means margin calls, risk limits being breached, or a macro catalyst that makes cash suddenly more attractive than anything else. The actionable insight here, when you see this kind of breadth, crypto, chips, and international equities all moving together, the instinct to pick through the wreckage for individual winners is premature. Understanding the macro driver comes first. Position, sizing decisions, and re-entry analysis come second. Jumping into discounted assets before the mechanism is understood is how disciplined investors make undisciplined mistakes. Korean chipmakers deserve more attention here than most Western financial media will give them. South Korea's semiconductor sector is not a peripheral market. It is a direct read on global technology demand, because Korean manufacturers sit at the upstream end of the global supply chain for memory, logic chips, and the components that go into data center infrastructure. When Korean chipmakers fall 6% in a single session, the market is expressing a view about technology demand that eventually shows up in U.S. earnings. Micron's pre-market decline fits this logic precisely. Micron is one of the few remaining U.S. headquartered memory chip manufacturers. It is in many ways the American analog to the Korean memory giants. When they fall together, the market is not saying there is a Korea-specific problem. It is saying there is a demand or margin outlook problem across the entire memory ecosystem. Now, here is where analysis requires intellectual honesty. We do not know from today's headlines whether this sell-off is driven by new fundamental data, a demand warning, a guidance revision, or a geopolitical development, or whether it is primarily technical, driven by over-leveraged positions unwinding in a low liquidity window. Both scenarios produce the same price action in the short term. They produce very different outcomes over the following weeks. What we can say with confidence is that the semiconductor sector functions as one of the most reliable leading indicators in global markets. It is cyclical, it is globally integrated, and institutional investors treat it as a real-time GDP proxy. A 6% single-session move in Korean chipmakers is not something you contextualize away. That magnitude demands a second look at broader macro assumptions. If you hold tech-heavy equity positions, or are long any proof-of-work cryptocurrency whose mining economics depend on chip availability and energy costs, this particular signal is directly relevant to your portfolio. There is a concept in portfolio theory called correlation risk. and it becomes brutally relevant in exactly the kind of session we're seeing today. Under normal market conditions, crypto and semiconductors have meaningfully different correlation profiles. They respond to different catalysts, they are held by different investor pools, and their volatility schedules don't align. Diversification between them provides genuine risk reduction. But correlation is not a fixed number. It is a dynamic variable that spikes toward one during stress events. When institutional investors face margin pressure, redemption requests, or risk limit breaches, they sell what is liquid first. Crypto is highly liquid. Large cap tech is highly liquid. Core inequities are liquid for international funds that need to reduce exposure quickly. The result is that in the worst moments, the moments when you most want diversification to protect you, it tends to disappear. This is not a new phenomenon. We have observed this dynamic in prior stress periods across markets, and the academic literature on liquidity-driven correlation is well established. But understanding it intellectually and feeling it in a live portfolio are genuinely different experiences. So what is the framework response to a day like today? First, resist the urge to act in the first hours of a broad sell-off. Price discovery in a correlated liquidation event is unreliable. Assets overshoot on the downside. Second, identify which assets in your portfolio are down because of fundamental deterioration versus which are down because they were liquid and got caught in the indiscriminate selling. Those are different problems requiring different responses. Third, and this cannot be stressed enough because this is not financial advice and your specific situation matters, understand your own liquidity position before the market forces you to understand it for you. The investors who get permanently impaired in these events are rarely the ones with bad analysis. They are the ones with leveraged positions who had no choice but to sell at the worst possible moment. We open by asking what story a synchronized 3-asset class sell-off is actually telling. The answer: it's a liquidity and risk appetite story, not an Ethereum story or a Micron story. The mechanism matters more than the ticker. The follow-up question worth sitting with: if Korean chipmaker moves historically lead U.S. tech earnings revisions by 1 to 2 quarters, what does a 6% single-session move in June 2026 imply for second-half earnings season? That's the next video. Subscribe so you don't miss the analysis when it lands.